Hey everyone, George here. So today we're going to talk about income splitting, which can be a valid tax strategy for people in the right situation. This can often entail setting up an LLC or corporation for a family member, and it would definitely have tax benefits, but there's definitely pros and cons related to doing this, and you would need to do things correctly, and it would need to fit your situation. Otherwise, you could end up in a whole lot of mess. So without further ado, let's get started. So one of my clients asked me about this today and I thought I'd make a video over it. So how do you keep your hard-earned money, and is there anything you can do to help move the income downstream between brackets between family members? So this, you'd need to really be careful. The structure of your setup would need to be reflective of the economic substance of what's actually going on in your situation. Said differently, the IRS doesn't care about your intentions and you wanting to pay less tax. They just care about the facts and circumstances. So before we go over what income splitting actually is, let's go over what it is not. So income splitting is not hiding money. It's not paying a family member for work they didn't do, or paying 50 grand to your kids for doing nothing. Income splitting is actually a legitimate business strategy where you often de-risk different business lines or services by paying family members for real wages for real work they performed. And in doing so, setting up a separate business for, let's say, your child, your parent, and shifting income for ownership and risk delineation, from your higher tax bracket to presumably a lower tax bracket family member for real work that they really performed. The IRS, presumably in the event of an audit, would check for two things ultimately: who actually earned the money, and did the family member actually contribute in any way. So let's say in one situation where you have a construction company, and let's just say you have a parent that owns an LLC and they provide services to your construction company. So what are examples of what the family member's LLC can do? They can offer real services like managing or handling your payroll, outsourced office management or virtual assistant duties, outsourced marketing, or leasing you equipment and managing property. Now, it really should be set up as a separate business with its own EIN, its own bank account, and a written contract with market rates. So let's say you have a parent who actually you pay, say, $5,000 a month to for doing your office management duties and virtual assistant duties. The IRS is really going to look for, did this parent actually work for the LLC, and is $5,000 a month a fair price? If the answer is yes to these questions, then you're in the clear. If the answer is no to any one of them, then it's considered a sham setup. So what are some red flags to avoid in this kind of setup so you don't get flagged as a sham setup? So I'm going to put them down here and let's go over them. So red flags to avoid: no written contract between you and your family business. Like I said, there should be a written contract. It should be at market rates. The family entity only works with your construction business. If you're their only client, that would incline them to think, it's more likely to be a sham setup. Paying way more than market rates for the services. Again, they should be at comparable rates. If you were to just Google or look up your service, maybe document 2 or 3 other vendors that provide comparable services for those rates. Number 4, the family business has the same address and same bank account as your construction business. Again, you need to set up a separate EIN, separate entity, and once you get that new EIN, you should set up a new bank account. The address as well. Ideally, you don't want it to be the same address. They'd be more inclined to think it's a sham. You could always get a PO box, a virtual address, something different to de-risk yourself in that regard if you do live in the same place and use a home office. And number 5, family members do no real work but are getting paid. Yeah, that's the ultimate thing. You need to be able to show somehow, are there emails being sent? Are there calendar invites being booked? The burden of proof would be on you as the taxpayer, so you need to be able to prove that there is some work being performed at this entity. So when does it make sense to use this tax strategy? Number 1, when your business is very profitable, you're making good profits, and it makes sense that you're at a much higher marginal tax rate, between Fed and state, and there is room to move in terms of, potentially having income shifted for actual work performed to another family member at presumably lower income tax rate. Number 2, when you've gotten a family member with real skills that they can provide you service with, not just somebody that you're moving money over to. Number 3, when your family member takes on real risk, like there is a different performance obligation in the work that they perform, and it does seem like they're doing something entirely different than what you're doing, and there's presumably additional risk for them involved as a business. And finally, this should really look like a long-term, business setup, business strategy, rather than, one-time money shifting thing. So what are the pros and cons of income splitting? So the number one pro that's obvious is the tax savings. So presumably when you move that income down to a lower tax bracket, with, say a different family member that you trust, that's the most obvious benefit to this strategy. Number 2 is asset protection, is, delineating the risk and keeping business risks separate, between entities, between people. Number 3, retirement plan options. With another entity, another person involved, you have more versatility in terms of the retirement plans that you can set up for each people, more contribution limits, all that between all of you. And number 4, risk management. Again, so this is like you're spreading the risk among different entities, different people, and that really helps in terms of asset protection. What are the cons? So number 1, obviously, if you do get audited and it's considered a sham setup, then it would potentially be reversed and you could owe back taxes, penalties, and interest. Number 2 con is the setup complexity. So you would obviously need to set up a separate entity. There's a setup cost, usually for legal or accounting. Also, every year you have to file another tax return. You have to pay another franchise tax to the state potentially. So it's just, administratively, it's more paperwork and things to keep up with. So this really would serve a benefit if you're making a lot of money, not just say $50,000 of net income. Like you should really be in the higher tax brackets in order for this to make sense for you. If you want to use family entities and income splitting, it can be a powerful tax strategy, but again, the economics need to be reflective of the structure of the whole setup. Otherwise, you don't want it to be flagged as a phony business of any sort. It could just cause you more headaches than it's worth. So there you have it. If you want to use family entities and income splitting, it can really be a powerful strategy, but again, the structure needs to be reflective of the true economic substance of what's going on. I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.